Tēnā koutou tātua, and welcome to our third deep dive series on NZ IFRS 18, the new standard on the presentation and disclosure of financial statements. This is our third deep dive series into the third aspect of NZ IFRS 18, management defined performance measures. My name is Nimish Beta. I'm a technical director in the accounting standards team of the ETSAB, and I'm joined today by Carly Berry, our senior project manager in the accounting standards team. So before we start, I wanted to give a quick overview of the External Reporting Board. Our purpose is to promote trust and confidence, transparency and accountability through high quality external reporting and assurance. And we do this through various mechanisms, through the reporting strategies and frameworks, the financial reporting standards themselves, climate reporting standards, and the auditing and assurance standards. We don't control who has to apply our standards. That's determined by primary legislation and Parliament, but we do determine what is reported within our standards. And our strategy is to be internationally aligned and locally relevant. And NZ IFRS 18 certainly helps us in that respect around being fit for purpose to provide the right information to users in New Zealand. And we do webinars like this to help support the adoption and implementation of our standards. So what will we be covering today? Today's deep dive is on management defined performance measures, or MPMs. And today we'll take you through the reasons for these new disclosures, how to identify an MPM, what disclosures you do need to make around MPMs if you do have one, and some key practical considerations for preparers. It's worthwhile noting that if you are a Tier 2 for-profit reporting entity, we have provided reduced disclosure regime concessions around MPM disclosures. Therefore, if you are a Tier 2 entity and you elect to take those disclosure concessions, you don't need to make any disclosures around MPMs in your financial statements, and therefore this entire webinar may not be appropriate or relevant to your financial reporting. With that, I will pass you over to Carly to take you through NZ IFRS 18 and how to identify an MPM.
Thanks, Nimish. So let's start off with a recap of a few key facts about NZ IFRS 18. Now, this standard is the New Zealand equivalent of the ISB, or International Accounting Standards Board's IFRS 18, and replaces NZIS 1, Presentation of Financial Statements, when applied from 1st of January 2027. Now, early application is permitted for those who would like to early adopt. Now, as NZ IFRS 18 is a general presentation and disclosure standard, all for-profit entities will be impacted to some degree. Now, NZ IFRS 18 introduces 3 sets of new requirements. In our June and August deep dives, we covered the first 2 sets as shown here. You can access the slides and recordings for our June and August deep dives through the slides here. In today's deep dive, we will cover the disclosure requirements for management-defined performance measures, or MPMs for short, which are a subset of non-GAAP or alternative performance measures. As Nimish has already mentioned, Tier 2 entities can choose not to disclose information about MPMs due to RDR concessions. So non-GAAP financial information can be useful for entities and users, as it can provide additional insight into an entity's financial performance, financial position, and/or cash flows. Typically, these measures are communicated outside the financial statements and are therefore unaudited. The ISB noted concerns from users that it is not always clear why a particular non-GAAP measure is communicated or how it is calculated, and sometimes it can be difficult to find information about these measures as they wouldn't necessarily all be in the same place. To respond to these concerns, NZ IFRS 18 requires entities to identify a subset of non-GAAP measures, that is, MPMs, in order to provide information on these measures within the financial statements themselves. Doing so will help to improve the transparency of these measures, that is, what they communicate, how they are calculated, and how they compare to NZ IFRS measures. Of course, disclosing information about MPMs within the financial statements brings them within the within the scope of the financial statement audit. This is a key change which will have implications for both preparers and auditors. We will highlight this again later on in this presentation. As you'll see shortly, MPMs only relate to financial performance, as this was a focus of the ISB's project to develop IFRS 18. Measures relating to other aspects of the financial statements, such as cash flow measures, may fall within the scope of the disclosure requirements through current and future ISB projects. So how would you go about identifying an MPM? Here's what the standard says. An MPM is a subtotal of income and expenses that an entity uses in public communications outside the financial statements to communicate to users management's view of an aspect of financial performance as a whole. A subtotal of income and expenses listed in paragraph 118 of the standard, or specifically required to be presented or disclosed by an NZ-IFRS, is not an MPM. Now that is quite a mouthful, but the standard does contain a lot of guidance to help you assess whether a non-GAAP measure is an MPM as defined. We will break down this definition into 3 key elements and discuss in more detail over the next few slides. The key to keep in mind throughout that the purpose of identifying MPMs is to provide the necessary disclosures in the financial statements for users, to help them understand what the measure is, how it is calculated, and how it relates to NZ-IFRS measures. First of all, an MPM is a subtotal of income and expenses. This means that non-GAAP measures, such as adjusted revenue or normalized expenses, cannot be MPMs, as they are not subtotals of income and expenses. Similarly, non-financial performance measures such as customer retention rate and measures such as free cash flow would not be MPMs either. Some examples of subtotals that would be MPMs, if the rest of the MPM definition is met, are shown here. Now, please note that these subtotals do not need to be presented in the statement of profit or loss to be MPMs. Certain subtotals of income and expenses would not be MPMs, regardless of whether the other parts of the definition are met. This includes required subtotals under NZ-IFRS, such as operating profit or loss. Other subtotals of income and expense are commonly understood or well defined, such as gross profit and profit or loss before income taxes. Therefore, the MPM disclosures would not provide useful information and are therefore not required. Paragraph 118 in the standard contains a list of the subtotals of income and expense, other than those required under NZ-IFRS, that are not MPMs. Now, other than those subtotals which are explicitly excluded from the scope of the MPM disclosures, there are other subtotals of income and expense which might be MPMs, depending on the circumstances. Let's take a look at financial ratios. These are not MPMs, as they are not subtotals of income and expense. However, the ISB wanted to ensure that subtotals that are only used in ratios and are not communicated on their own will still be subject to the disclosure requirements in NZ-IFRS 18 to ensure transparency over these measures for users. Therefore, NZ-IFRS 18 specifies that a subtotal that is a numerator or denominator in a financial ratio is an MPM if the subtotal would meet the definition of an MPM if it were not part of a ratio. Let's take a look at an example. A company may communicate an adjusted EBITDA over net debt ratio to investors, as this communicates management's view of an aspect of the company's financial performance as a whole. But the company does not communicate adjusted EBITDA as a standalone measure. Without an explicit requirement in NZ-IFRS 18, MPM disclosures about the adjusted EBITDA numerator would not be provided to users. But since the subtotal otherwise meets the definition of an MPM, the MPM disclosures are required for adjusted EBITDA. So it makes sense that adjusted EBITDA would be an MPM if the rest of the definition is met. But what about EBITDA, or earnings before interest, tax, depreciation, and amortization? Would this not qualify as a commonly understood subtotal and therefore form part of the list in paragraph 118? Now, the ISB did consider defining EBITDA, but research showed that although it is one of the most commonly used measures in communications to users, there's no consensus among investors about what EBITDA represents. So the standard avoids using the term EBITDA and instead specifies an operating profit or loss before depreciation, amortization, and impairments within the scope of NZIS 36. Now that's a pretty long title, so let's call it OPDI for short. Now this is not a mandatory subtotal, And it's not an NPM because it is well defined and therefore included within the list of excluded subtotals in paragraph 118 that I mentioned earlier. So if your EBITDA measure is exactly the same as OPTI, then you would not have an NPM and would therefore not have to provide the NPM disclosures for it. Likewise, if the two measures are not the same, then your EBITDA measure is an NPM. Another thing to note here is that the standard does not prohibit you from labeling the OPTI subtotal as EBITDA in the statement of profit or loss, if this is an accurate description of the measure. For example, when all earnings are included in operating profit or loss, because no income or expenses are classified in the investing category. Now, lastly, some subtotals of income and expense provided in public communications outside the financial statements might relate to a reportable segment as defined in NZ IFRS 8. These subtotals are not NPMs if they do not provide information about an aspect of the entity's financial performance as a whole. But sometimes this could indeed be the case. For example, if the segment contains a single main business activity and you present a subtotal relating to that segment in the statement of profit or loss. In a situation like this, the subtotal might be an NPM. Now, subtotal of income and expense must be used in public communications outside the financial statements to qualify as an NPM. Examples of public communications are management commentary, press releases, and investor presentations. The standard does not define public communications, so we expect that there will be some judgment involved in determining what counts as a public communication outside of financial statements. The standard does help to a certain extent by explicitly stating that certain communications, such as oral communications, written transcripts of oral communications, and social media posts, are not public communications for the purposes of identifying NPMs. These comms are likely to be amongst the most challenging to monitor, and in any case, information about these NPMs and these communications would likely be included in other forms of communications already. Now, please note that in organizations where the finance teams and investor relations team are separate, it is especially important to ensure that you understand what financial information is included in investor presentations and other public communications, so that a complete population of NPMs can be identified. Since NPM disclosures will need to be audited, auditors will also need to assess the completeness of NPMs and gain an understanding of how the NPMs have been identified. So over what period should you consider public communications? Before taking a look at this, it is important to note that NPMs relate to the same reporting period as the financial statements. For example, a subtotal that relates to the interim financial statements, but not to the annual financial statements, can only be an NPM in the interim financial statements. Likewise, a subtotal relating to the annual financial statements, but not to interims, can only be an NPM in the annual financial statements. Now let's take a look at the timing of public communications. Example A on this slide depicts a situation where a company routinely issues public communications up to the date the financial statements are issued. The NPMs relating to the 2028 reporting period, that is, the current reporting period, are identified by considering public communications issued up to the date of the financial statements being issued on 28th of February 2029. However, what happens if you routinely issue public communications, such as press releases, after the date the financial statements are authorized for issue? How would you have identified your NPMs and disclosed information about them in the financial statements if a key part of the definition, that is, public communication outside the financial statements, only occurs once it is effectively too late? In a situation like this, you would need to refer to public communications related to the previous reporting period to identify NPMs for the current reporting period. You can see this in example B here on the slide, where the company issues public communications only after 28th of February 2029. The company would therefore need to refer to public communications from the 2027 financial year, that is, the prior reporting period, to identify its NPMs. Now, please note that a measure used in public communications during the prior reporting period might not be an NPM in the current reporting period, but there would need to be evidence indicating that a measure will not be included in public communications related to the current reporting period. We'll talk a bit later about the disclosures required when an MPM is no longer used. One last point I want to make before leaving the slide. It may be that you routinely issue public communications relating to the current reporting period, both before and after the financial statements are issued. In that situation, to ensure completeness of MPMs, you should consider public communications relating to both the current and prior reporting periods. The final aspect of the MPM definition that we will cover is the requirement for the subtotal of income and expenses to communicate management's view of an aspect of the entity's financial performance as a whole. Here I just want to emphasize that MPMs focus on communicating an aspect of an entity's performance and not on communicating management's performance. So a subtotal used solely for the purpose of measuring management's performance, for example, a measure used only internally for the purpose of management remuneration, would not meet the definition of an MPM. It makes sense that an entity communicates a non-GAAP measure to users in order to provide a specific view of financial performance, in addition to information prepared and presented in accordance with NZ-IFRS. Therefore, the standard presumes that if an entity publicly communicates a subtotal of income and expenses outside its financial statements, the subtotal is communicating management's view and is therefore an MPM. But if an entity has reasonable and supportable evidence to show that the subtotal does not communicate management's view, and there is a reason for using the subtotal in public communications other than for this purpose, then this presumption can be refuted or, technically speaking, rebutted. So what would qualify as reasonable and supportable information? NZ-IFRS 18 contains guidance on what you should consider here, which is summarized on the slide. For example, a subtotal might be communicated externally solely to satisfy a request from an external party, or it is required to be communicated solely for the purposes of complying with law or regulation. A subtotal might be communicated without prominence, which is another example of reasonable and supportable information. For example, an entity may include in its public communications a net debt measure comprised of assets and liabilities. Net debt is, of course, not an MPM because it is not a subtotal of income and expenses. However, an entity may also include a subtotal such as cost of net debt as supplementary information. If the entity can demonstrate that the subtotal is communicated without prominence because it is supplementary information for the net debt measure, and the entity does not use the subtotal internally to assess and monitor the entity's financial performance, this may be reasonable and supportable information to rebut the presumption. However, please be aware that if there are numerous references to the subtotal, accompanied by management analysis and commentary, this would be evidence that the entity cannot rebut the presumption. Now, this brings me to an important point to keep in mind. Where a subtotal is publicly communicated, but is not used by management internally to assess or monitor financial performance, this would be reasonable and supportable information indicating that the subtotal does not communicate management's view. However, there may be a situation where a subtotal used in public communications does not communicate management's view, but is adjusted for use internally by management to assess or monitor the entity's financial performance. In such cases, you must use judgment to assess whether the subtotal used internally is sufficiently similar to the subtotal used in public communications. The more similar the subtotals are, the more likely it is that the subtotal used in public communications communicates to users of financial statements management's view of an aspect of the financial performance of the entity as a whole. We've now had a look at all three key aspects of the MPM definition. A little while ago, I mentioned that MPMs do not have to be presented in the statement of profit or loss, but can they be? The answer is yes, as long as the MPMs comply with certain requirements. The MPM must contribute to a useful structured summary of income and expenses. The MPM must also be compatible with the structure of the statement of profit or loss. Therefore, a subtotal that includes some income from the investing category and some expenses from the financing category could not be presented in the statement of profit or loss, as the subtotal would not fit within the defined categories. And finally, the MPM must also comprise amounts recognized and measured in accordance with NZ-IFRS. This is a good time for me to mention that the ISB did not want to restrict the way entities calculate MPMs, as this might prevent them from disclosing useful measures. Therefore, MPMs do not need to comply with NZ-IFRS, unless they are presented in the statement of profit or loss. However, even if they are not presented in the statement of profit or loss, by virtue of the fact that information must be disclosed about them in the financial statements, MPMs must still comply with the general requirements for information included in the financial statements. That is, the MPM must faithfully represent the aspect of performance that it claims to represent, and the MPM disclosures must have comparatives and meet the aggregation and disaggregation requirements in NZ IFRS 18. Now, if you're wondering what specifically needs to be considered to ensure faithful representation, I've spoken before about how the MPM disclosure requirements are intended to provide transparency about how MPMs are calculated, what they communicate, and how they relate to NZ IFRS measures. That transparency helps to ensure faithful representation. I'll now hand over to Nimish. Thank you.
Thanks, Carly. So Carly has taken us through how to identify a management-defined performance measure, but what exactly do you need to disclose in your financial statements? So there are two types of disclosures. There are general disclosures for the entirety of your management-defined performance measures, and then specific disclosures for each individual MPM. So for general disclosures, you'll need to ensure that all of your management-defined performance measure disclosures are in one single note to the financial statements. This isn't in the primary financial statements. This isn't an accounting policy. This is not an appendix that supplements the financial statements. This is a single note within the financial statements themselves. This is fundamentally a part of your financial statements going forward. You'll need to provide two general overall statements about what management-defined performance measures are. So that's providing a statement that the MPM provides management's view of an aspect of the entity's financial performance as a whole, and a statement that the MPMs may not be comparable with measures and labels that other entities may use. And you must label and describe MPMs in a clear and understandable manner. As Carly mentioned, your MPM should faithfully represent what you are trying to communicate to your users. So if you use the words normalized or exceptional or non-recurring, being able to explain to a user what those words mean and what the boundaries of what you may be adjusting and what you're not adjusting are will help contribute to labeling and describing the MPM in a clear manner. On the next slide, we talk about the disclosure requirements for each individual MPM. So for each individual measure that you do consider to be an MPM, you'll need to provide a description of the aspect of financial performance that it's trying to communicate. That means explaining what you are adjusting and why you consider that to be useful for a user to also adjust when they look to analyze the financial performance of your entity as a whole. You'll have to provide a description of how the MPM is calculated. This may very well include cross-referencing to other notes in the financial statements to explain where those numbers and those balances are coming from and where additional context or information behind those adjustments can be found in the financial statements. Excuse me. You'll need to provide a reconciliation for each MPM, which we will go on to shortly, but this will include the income tax effect and the effect on non-controlling interest for each adjustment that is made to the NZ-IFRS number to your management-defined performance measure. And you'll need to then flow on from that and provide a description of how you have determined the income tax effect for each individual adjusting item. So the income tax effect is quite a specific and new area for many entities. So on the next slide, we provide a little bit more information around what this represents and how this could be calculated. Many entities we know, when you're looking at assessing your own performance, you don't necessarily think about the income tax effect associated with each individual adjustment. Normally, tax is done as an overall assessment of overall profitability at the end. So this requirement might feel a bit new and a bit more nuanced than what you would do internally, but nevertheless, the users of the financial statements do find value in being able to assess the pre-tax impact and the post-tax impact of certain transactions and adjustments. So NZ IFRS 18 allows for an entity to determine the income tax effect using one of three methods, either the statutory rate that's applicable to the transaction within the relevant jurisdiction, or a reasonable pro rata of the current income tax rate and the deferred tax rate in the relevant jurisdiction, if you believe there will be quite a significant deferred tax implication of that transaction, or another method that achieves a more appropriate allocation under the circumstances. If you do take the third method, I would encourage you to ensure that your rationale and documentation is evident, because that method does require a lot more judgment than the others. So being able to explain why you consider that to be a more appropriate allocation will be very beneficial for your own records and when you talk to your auditors about it. Income tax effect may sound quite mathematical. It's just the rate calculated multiplied by the transaction, but there is a bit of judgment and a bit of decision making that needs to be done when determining what the right income tax effect is. So on the next slide, we have an illustrative example of what the management defined performance measures disclosures could look like. So again, as mentioned, it's very important to recognize that management defined performance measure disclosures is not just a reconciliation. A lot of people feel that as long as you provide a reconciliation of the NZ IFRS number to the MPM, that will meet the requirements. But the MPM disclosures under NZ IFRS 18 is a bit more. These framing disclosures are quite important to help users understand what you are trying to tell them. So I encourage you to go back to these slides and look back at this webinar when you go to prepare your MPM disclosures for the first time. The level of detail and judgment needed will depend upon each individual entity, but these illustrative examples and the IASB's illustrative examples provide helpful information on how to frame your disclosures and what level of detail is expected by NZ IFRS 18. On the next slide, we provide an illustration of the reconciliation itself. So you will see that this reconciliation has been presented in a table format, which shows the NZ IFRS number and the reconciling adjusting items that are done to get to your management defined performance measure. And likewise, between the two green rows, you will see the income tax effect being calculated against each individual adjusting item and the relevant non-controlling interest impact and the final line item. This is just an example of how you can present your reconciliation of MPMs. You do not need to follow the specific format, and you may not even consider it necessary to present it as a table. But again, this is a very helpful illustration as to how you could present your reconciliation notes to meet the requirements of NZ IFRS 18. And on the next slide, we provide additional supplementary disclosures. So again, the reconciliation may need additional information to help explain what adjusting items and what impacts those are having. A lot of this will come down to having to disclose how you've determined the income tax effect for each adjusting item, and therefore you may need supplementary disclosures underneath or to accompany the reconciliation to show what exactly each adjusting item is, where further information can be found about it, and how the income tax effect has been calculated and determined. So that gives an illustrative example of how your MPM disclosures could look like. But what happens if you start changing or creating new MPMs on one period compared to the other? So when you do change an MPM across reporting periods, additional disclosures may be triggered under NZ IFRS 18 to help the continuity of information to users, to ensure that information that they weren't using doesn't suddenly disappear or new information suddenly is provided without context and reference back to the previous reporting period. So if you do change the calculation of an NPM, or you introduce a new NPM, or stop using a previously disclosed NPM, additional disclosures will be needed in that reporting period to help explain the change, the additional NPM or the ceasing NPM and its effects. It's a helpful explanation as to why you have changed, why you no longer consider previous NPMs to provide useful information to users, or why you consider a new NPM to provide more better useful information to users. And you may need to restate comparative information to reflect the change, the addition or the cessation, unless you consider it impractical to do so. The determination of an NPM is not an accounting policy. It's simply an internal mechanism of how you view the entity's performance as a whole. So changing NPMs is not an accounting policy decision. But NZ IFRS 18 does explicitly allow entities to consider the requirements of paragraph 50 of NZIAS 8 around the practicalities of making comparative information. And if you do determine that it's impractical to restate comparative NPM disclosures, then you may be able to apply paragraph 50 of NZIAS 8. But if you do, you would need to disclose that you cannot restate comparators because it has been determined to be impractical to do so. And that brings us on to our next slide around the impact that NZ IFRS 18 is expected to have on the use of non-GAAP measures. We understand that non-GAAP measures have been used for a long period of time in New Zealand. This is a common way of being able to communicate effectively to your users of financial statements, being able to give them greater insight as to how you as management consider and view your entity's performance rather than the accounting standards view of performance overall. NZ IFRS 18 isn't intended to restrict what sort of measures you use and how you communicate them to users. This isn't trying to stop you from using a particular measure or forcing you into a particular type of measure. All NZ IFRS 18 is trying to do is to aim to provide more transparency to how you calculate your non-GAAP measures and to anchor them to an NZ IFRS 18 number so that users can understand what information you're using and how they can determine that from NZ IFRS financial statements. NZ IFRS 18 does require more detailed information around tax impacts and non-controlling interest impacts for each reconciling item. This is likely to be more detailed information than what entities are currently using for their own non-GAAP measures internally. So more record keeping and more documentation may very well be needed to ensure that those numbers are accurately reflected. NZ IFRS 18 does create a mandatory new operating profit subtotal within the statement of profit and loss. And this subtotal may very well be a subtotal that entities adopt or use more for their own internal view of management performance. So the newly defined subtotals in NZ IFRS 18 could potentially reduce some of the non-GAAP measures that you choose to report. It's not intended to, and it's not trying to, but you may very well find that some of the mandatory requirements of NZ IFRS 18 may just be more efficient and effective to use for your own internal considerations of performance. And likewise, if you are a FMC reporting entity, you would be familiar with the FMA's guidance around disclosing non-GAAP measures. This is a guidance document that the Financial Markets Authority released that provides their expectations around the use of non-GAAP measures outside of the financial statements. NZ IFRS 18 doesn't conflict with the FMA's guidance, but it does codify some of their existing principles into the accounting standards and brings it into the scope of financial statements and relevant note disclosures. NZ IFRS 18 provides a good opportunity for you to reflect upon how you use non-GAAP measures and how you can consider the requirements of NZ IFRS 18 and the FMA's guidance to ensure that both expectations are met and that your communication with users are effective. On the next slide, we provide a summary of the practical considerations that you as an entity might face when you go to think about management-defined performance measures. A key area, as Carly mentioned earlier, is the judgment that is required around identifying NPMs. You should consider all the facts and evidence that you can and document your rationale to be able to explain to senior management and to governance and to your auditors. You should be documenting all the judgments that you are making and what you have considered, which elements support your arguments and which don't, the arguments in favour and against, and how you've come to a conclusion, as that application of judgment is fundamental to NZ IFRS 18 and very well may be areas that auditors question and challenge as they look to audit your financial statements with NPM disclosures. You should expect auditors to challenge you, so being able to be robust with your conclusions and your judgments will make the process a lot easier. You should ensure organisational involvement across management, all levels of management and investor relations teams. There is a risk that your left hand may not understand what the right hand is doing, and the scope of NZ IFRS 18 is around information that is communicated outside of the financial statements. So making sure that all aspects of your organisation is attuned to the communication that is being made externally and how that may very well impact on financial statement note disclosures is quite important. Comparative information is necessary for NPMs. So while a 1 January 2027 mandatory date for NZ IFRS 18 may still seem a bit in the future, thinking about this now and up front and how it may very well impact your 2026 numbers will be very important to ensure that all the right information is being captured and to avoid any unnecessary problems when you get to adopting NZ IFRS 18. You may very well need to reflect upon the systems and processes you have in place and start adopting them in 2026 to make the transition in reporting under NZ IFRS 18 a lot easier. And as mentioned before, NPMs are subject to audit. This is a new area for many auditors. So working with your auditors, engaging with them early, providing the information that they request and being able to justify your conclusions based on evidence will be helpful. Work with your auditors to ensure that the right level of useful detail and information is provided to users. And with that, I'll bring you to the next slide around our educational material around NZ IFRS 18. We have spent a lot of 2025 helping entities understand the requirements of NZ IFRS 18, and we have done a numerous level of information and educational material to help entities understand the requirements and start thinking about the practical implications of this early rather than later. On the slide, you'll see a number of different mechanisms and communication tools we've had, and we encourage you to refer back to this information where possible as you go about your transition to NZ IFRS 18. And with that, I will bring you to a close to this webinar. Many thanks for listening to this, and we hope this provided you with some useful insight into the requirements of NZ IFRS 18 around management-defined performance measures and what sort of expectations and disclosure requirements there are going forward. If you do have any questions on NPMs or NZ IFRS 18 in general, please do reach out to us at the External Reporting Board. We cannot offer you specific accounting advice, but we are here to help explain the requirements of our standards and to give you further things to think about as you go about your application of our standards. So thank you very much for listening to this webinar, and we hope you have a great rest of your day. Thank you, and mā te wā.
Thank you.